All right, let's catch up again with equities. Of course, inflation continued to be a sticking point. How we negotiate that with portfolio construction, and the RBA locally, of course, flagging a possible rise in interest rates from pandemic lows of 0.1%. So, how do you navigate this space? For his take, we're joined by Marcus Bogdan from Blackmore Capital. Marcus, good to catch up with you. So, interesting as to where we're at the moment, and this morning we're talking about that the inversion of the yield curve and perhaps what that is indicating as far as investors, what they should be paying attention to, whether we're likely to see a recession ahead, particularly in the States. How are you playing this at the moment?
Well, if you look at Australia, and I think we're fundamentally, touch wood, remaining the lucky country. We're seeing very good economic growth. The indicators on employment, on the consumer, we're seeing fiscal expansion still, and this is translating into higher corporate earnings. So there are fundamentally so many challenges out there in the world. We've had a pandemic, war, floods, but despite all of that, we're still generating good economic numbers, and hence I think that's been reflected in the share market and such a strong returns that we're seeing last month. So in terms of portfolio positioning, we're certainly going into a period of higher rates and continued high in inflation. And so the sorts of assets and the exposures that we want to be in are areas like real assets, materials, energy, those defensive industrials that can pass through price increases, consumer staples. I think supermarkets will be a beneficiary of higher inflation, and then the reopening play of healthcare.
All right, when you mention energy and materials, obviously we're seeing where those commodity prices are going at this point. You don't feel as though we're at the peak. You're still happy to be well exposed in those sectors then?
Yeah, I think you make a good point, because they have been very strong contributors to returns in the market, and you've always got to be mindful of that. But they are still come upgrades in terms of their earnings, given just the persistence there we're seeing in higher prices across the full spectrum of commodities. And so as there's still come upgrade in earnings, the valuations still don't look too high to our mind. And they've got incredibly strong cash flow, strong balance sheets, and companies like BHP are paying record dividends.
All right, beyond BHP, which other ones are you looking at the moment?
Well, we do like those metals that will be benefiting from decarbonisation that we'll see over the next decade or so. So Oz Minerals is our preferred exposure there, particularly on copper. And then on the energy side, we do like Santos, which we think have got a number of catalysts there to create shareholder value over the foreseeable future.
All right, Marcus, you've also mentioned consumer staples then. You're seeing that those, in particular those supermarkets, are going to be passing those higher costs on to consumers. So which ones are you focused on?
We definitely like the largest player, Woolworths. It's been an underperformer, but we do believe that there'll be still good trajectory there in both revenue and earnings, and the valuation looks attractive. We like Endeavour drinks, so not only the BWS and the Dan Murphy side of that part of their portfolio performing strongly, but we do see a strong recovery in the hotels business as well. And then for the more income-orientated investors, we like coal. So really, across that spectrum of consumer staples, I think warrants a position in the portfolio.
Marcus, you're always favouring healthcare at this point. I know you've got a deep interest there. In particular, Which stocks are you looking at?
And you're right. I mean, healthcare has been a very underperformer in the market over the last three months or so. But we still like CSL. The uplift there we're seeing in plasma volumes. We think we'll see a good flu season for CSL. And we expect to see earnings recovery in FY23. But more closer to home, Ramsay and Healius are both strong recovery plays in healthcare.
And let's round it out. The other sector you're looking at, defensive industrials. Just reiterate as to why, and which ones you're looking at.
So even if we do see a slowing in the economy and persistence in inflation, we do think you want to be exposed to those companies in essential industries that have got a strong record of pass-through mechanisms of higher commodity prices, higher fuel prices, and the companies there have been companies like Amcor, Brambles, and Cleanaway, but all three are trading at sort of attractive valuation points at this point in time.
Marcus, just before you go, so they're the companies you mentioned there, and the sectors you're liking at the moment, where you see it's appropriate to have a well-exposed position. Which sectors are you avoiding at this point?
Well, we're still watching technology very carefully, and there was a point several weeks ago where those prices had come back quite materially. Companies like Xero, which have come back from sort of mid-hundreds back to below 100 now, slightly above. So at some point, technology, I think, will warrant a further positioning in the portfolio, but we still think that those valuations are still too high at this point in time.